G'day guys and welcome back to another Catapult market update. Today we've got the honour of having the co-founder and chief investment officer of DNR Capital. Jamie, thank you very much for joining us here in Adelaide.
No worries.
I'm very lucky to get in with all the restrictions back and forth.
Yeah, I think we had a storm in Brisbane overnight, so just snuck out ahead of that.
Jamie, we've seen you guys have had some fantastic returns recently. Given where we are now, given that we've now rallied with a lot of stocks above pre-COVID levels, iron ores are back, the banks have rallied hard. Where to from here?
Yeah, I think the challenges increase from here, and there was some very low-hanging fruit that existed during the COVID period, some extraordinarily cheap stocks. But I think the thing to bear in mind is that the economy's running quite strongly with the benefit of fiscal stimulus. So I think what we're focused on is trying to identify those stocks that can benefit from that. That's going to have some upside surprise from an earnings perspective. But also, I think it's a very stock picking market. There's going to be also stocks with negative surprise. There were some stocks that really benefited during the COVID period. You know, the retailers are benefiting from the handouts, and that may not be there over the next year. So you need to be a little bit careful on your stock picking. I think it's going to be a lot more challenging going forward, and there'll be some problem stocks to avoid. But if we can identify those stocks that are doing well and have a bit of balance across the portfolio, then I think that'll put us in good shape going forward.
Yeah. I mean, fiscal stimulus is one of the other ones. The other one that seems to be coming on the news all the time is inflation. So obviously inflation will eventually cause interest rates to rise if they're persistent. And if that happens, it sort of rebases all asset valuations.
Yeah.
What's your view on inflation and interest rates?
I think this is the most important thing to get right, and the key thing to focus on, because I do think the world's changed through COVID. There's been really significant changes, both politically and for the community. And from a political perspective, we've gone from a period post GFC where governments were focused on tightening their belts and austerity. Now everybody's cutting new checks, and you're seeing the community likes receiving free money, and the government likes being popular. So I think that's going to continue. A lot of infrastructure programs, that creates a different world. But we're also seeing a world where it's changing from a borders perspective. You're seeing leaders in France talking about halting immigration for 4 years. I mean, that's unheard of. And people are bringing supply chains closer to end markets. I think all of those things are potentially inflationary, as are some of the environmental and social and governance type changes. Increase in environmental tariffs that Europe's thinking of introducing. These are quite inflationary. Now, we are seeing some temporary inflation right now due to higher commodity prices. That might roll off. So I'm not so concerned about that. It's whether inflation expectations get embedded into people's belief, and they start to want higher wages as a result. And that's something that could emerge over the next couple of years. And as you say, asset prices have been helped by low inflation over the last decade. Some of those companies that have done very well under a low inflation environment might start to struggle, and there'll be some opportunities for stocks that typically do better as inflation rises.
Mm-hmm. We've seen that the managers who have been active have been able to perform pretty well in these recent times. We've seen value come back and growth sort of come back, especially in the tech space, right?
Yeah.
What's your view? Do you think this is temporary, or do you think that value may have a bit of a run here?
Usually, I think usually when you get a rotation from growth to value, it doesn't stop until you start to see really outstanding value in the growth phase. It normally overcorrects a little bit. And so I think we're only very much in the early phase. It's been such a long run in growth stocks. Although I would say the easiest gains from the growth to value has probably played out. I do think it's as I said, a stock picking market. There's going to be great businesses that are growth businesses that you can pick up that get oversold. We've been looking at a couple more recently that we just think we're happy to buy them at decent prices, but there'll be some value opportunities, particularly those that benefit from higher inflation should that come through.
Mm-hmm. Well, we're seeing that, based on the value to growth conversation, when you look at our index versus the US index, we're very much sort of more of a value-orientated world, and the US is very much tech and growth. How do you think we're going to fare versus the US going forward?
I think we do look pretty good in that environment, and particularly when you add inflation, because commodities tend to do well in an inflationary environment. So, we're well placed from that commodities perspective. And also, I think just some of our traditional industries which have struggled perhaps over the last decade, like banks and insurers and the like, look a little better. They're starting to take costs out and deliver better bottom line. The big US megatech stocks, the FANG stocks, the Facebooks and Amazons, I mean, they're great businesses. They'll continue to look pretty good, I think. But it's further down the line. There's been a bit of speculative fury in smaller tech stocks which don't make a profit. People hoping to find the next Facebook. I think that end of the market looks a little vulnerable. That speculative end. I do worry when you speak to your local barista and he's giving you stock tips and he's on Bitcoin, and it's all that sort of froth that's at that end of the market that I think is a little vulnerable.
I think one of the conclusions that we came from this sell-off was that you don't want to sell at the bottom, but you don't want to do nothing either. Is there any other lessons that you've learned?
Yeah, look, the big lesson was, just follow your process. We just sat down and worked calmly through our companies and think about the long term. We don't invest in stocks for the next result. We're investing for stocks for a 3 to 5, 10-year perspective. So a short-term hit to earnings doesn't impact value so much. It's what's this company going to look like in 3 to 5 years' time. And by taking that calmer view, often these sort of periods of instability presents fantastic opportunities to buy good businesses trading cheap, and you really look forward to those sorts of opportunities, and so you can rationally sort of work through the problems that might exist and identify those good companies.
Yeah, I think the global macro is just so hard to predict. It's just about having good fundamentals and a bit of common sense. Just looking at a company, and think, are they going to be able to grow? So,
yeah, exactly.
Beautiful. Thank you very much for joining us. Very happy to have you in Adelaide. Thank you guys for joining us as well.
Thank you.